Hey, all right, man. We are live once again, and it's a Saturday because I'm working tomorrow on Sunday. So, Saturday, I'm here with my friend Jeremy from dividendstockpile.com. I have that in the description below. So, definitely check the man's website out. Say hello, everyone, or say hello to everyone, Jeremy.
Hey everyone, thanks Russ for having me. Looking forward to it. Definitely make sure you put some comments in the chat and we'll talk to him later.
Yeah, so let us know. We're going to talk about our number one stock that we're buying, just something really quick and light. We're not going to go, 10 years deep into the financial statements, but yeah, I just wanted to share. I want you guys to share with us. I want to know what's at the top of your list that you're buying right now or wanting to buy, even if it's a little overvalued. So you're the guest, Jeremy. I will let you go first, and then of course we'll chop it up in the chat after we do our little presentation here, and we'll talk with all y'all people out there. So Jeremy is going to kick it off, and I'm going to put your stream on the or your screen here.
Awesome. All right. Well, thank you. So my dividend stock that I'm actively buying is Brookfield Asset Management. So here in the U.S., the ticker is BAM. BAM. I think in the Canadian market it's the same, but it's BAM.TO. So this is one that's been in the news a lot lately because they recently did a spinoff from their corporate partner. So Brookfield Asset Management used to be a conglomerate of different businesses. And so what they did is they split it off into two companies. So the old Brookfield Asset Management became Brookfield Corporation, ticker BN, and then they spun off their asset management team department. And that's what the new ticker BAM is. And so the reason I like them is because I really like some of their subsidiaries. I've been owning them for a very long time. You've probably heard of the Brookfield name, but Brookfield Renewable Partners, Brookfield Infrastructure Partners, and there's some other ones. So this is the asset manager that owns all those subsidiaries.
They have, when I see Brookfield, they're like a tangled web to me. There's so many Brookfields. So they all fall under BAM then? Is that what?
Yeah, all the subsidiaries. So if you see down in the overview, it talks about renewable power and transition, infrastructure, private equity, real estate, and credit. So this is the asset manager, basically the holding company for all those other subsidiaries. So all those organizations funnel through BAM, and then BAM is kind of like the parent. So if you invest in BAM as opposed to some of the other tickers like BEP, BIP, those, you basically get the fee income from all those little subsidiaries. The reason why I like Brookfield Asset Management so much is because they're choosing to do a very high dividend. So hopefully you can see this on, if you can switch over to the Yahoo page. I'm not sure if we can get that shared real fast.
Yeah, so BHP, I've been meaning to look more at BHP. Steve C was sharing it, I think because they have exposure to uranium and to mining and whatnot. Yeah, there we go. You took that. Okay, so.
One second. Yeah, so the nice thing about looking at it right now, and I'll get this on the screen, is.
Steve says BAM has no dividend. Is he wrong?
Well, that's actually what I wanted to just talk about. So if you go to somewhere like Yahoo Finance, it shows a zero dividend. And the reason for that is it's recently split off. So they haven't announced their first dividend. So all your financial websites out there aren't going to show the dividend. And so that's one of the reasons why it's so cheap right now and why I'm buying is because the general public doesn't understand how it's ultimately going to work. But BAM has agreed to pay out 90% of their revenues as a dividend going forward. And so it's going to be a very high dividend and high growth. So I'm going to share one more screen to kind of round that out.
That's really interesting, man. That is really
good. Give me 1 second. Sorry for the delays on the screen sharing.
No.
One more thing.
Yeah, because I was looking I want to get more into uranium, and I sold URNM, the ETF, because they stiffed me on the distribution. Okay. They didn't pay it. So I got out of them, and I'm looking to get into a bit of uranium.
Yeah, so for Brookfield, this is a news release they did about a month and a half ago. They said that the corporation itself, so the old, it's called BN now, is paying 7 cents per quarter. But the manager, which is what BAM is, 32 cents per quarter. So that's $1.28 a year. That's almost a 4% yield right now. So they are
Nice.
planning on having a very significant dividend. And then the management has guided for about 15 to 70% dividend increase every year going forward. So it's a quality company, huge reach across the globe, and it is going to pay a great dividend. So that's the one I'm looking at most right now.
Interesting. So in a way, it kind of feels like a Berkshire, where they have all the subsidiaries, and then they're kicking, they're kicking profits, and what would have been paid out as dividends, that's all going back to Omaha, that they end up, doing what they do with it. So is that kind of right? Like they have all the subsidiaries that are just going to be funneling money back to the parent then, right?
Exactly. And then the parent company can use those resources to go buy new projects around the globe that make sense, and they can divvy it up between all the subsidiaries. So if it's renewable energy, it's going to go to BEP. If it's a infrastructure play, it's going to go to BIP, and so on and so on. But ultimately, all the revenue that comes in goes back to the parent company. And because it's an asset manager, they're just going to funnel that dividend back out to us as shareholders. So definitely going to be pushing for that. I see Ivan just asked, it's going to be treated like a 1099 div, so you don't have to worry about that.
Really? Okay.
Mm-hmm. Yep.
All right.
Yeah,
Man.
I've owned BAM as well as BEP and BIP, and it's regular dividend income.
So for someone like me that was thinking about BHP, would it be better than to just buy the parent, do you think? Or is it a little, I don't know. So I'm trying to figure out how that works, because you can invest in the subsidiaries, right? And then you can invest. Well, I guess it's kind of like Aries. Like there's ACRE, ARCC, but then there's, is it ARES? Just the asset, the parent?
Yeah, so I invest in all of the subsidiaries as well as the parent company. So if you want to focus on a particular industry, so like renewable energy, you can just focus on BEP. If you like the infrastructure, so like the toll roads, the ports, things like that, you could do BIP. If you want to get a little bit of everything, plus all the other things the parents are doing, you can do BAM. So you have a bunch of different options there.
All right, yeah. So in a way, almost like I don't know. That's a bad analogy. It just sprung into mind Kenvue, which is going to be Johnson and Johnson's spinoff, where some people may not want to invest in the pharmacology or the pharmaceutical side of things and medical devices, and just want to, know that they own Band-Aid and Listerine. So yeah, you could invest just in that.
Absolutely,
So,
exactly. Gives you more options, and because they are focusing on their assets around the world, they're able to be a little bit more focused when it comes to the dividend, as opposed to owning the parent company. They're looking for the growth. So it's kind of for dividend investors, at least, it's definitely, in my opinion, a better way to go, is to go with BAM.
I'm going to put that on the list, man, because I like that it just has it encompasses so many different subsidiaries, and I don't know.
It does.
I love
And they have the size and the scale to operate across the globe. A lot of these municipalities and countries around the world have all these infrastructure needs, but they don't have the money to finance it. So they turn to people like Brookfield Asset Manager to finance that. And then, of course, Brookfield turns around and does long-term contracts with these governments. And that's how they can pay out such high dividends, is because they have 15, 20, 25-year contracts on some of their deals.
Yeah, I love those contracts with the government too. I mean, that's well, it can change, but while you have the contract and the getting's good, I mean, those are guaranteed dividends, regardless of what. I mean, there's always the chance of default, but that's pretty low, I would think. Pretty low.
And one last thing is BAM does non-recourse debt. So they do the debt based on the project. So even if one project fails, it's not going to take down the whole company. They tie all kind of debt to that one asset. So if a municipality does default on one, it's not going to affect the whole company. It just affects that one asset. So yeah, definitely take a look.
Little insulated. I like it.
Yeah, exactly. Good way of putting it.
So that's Steve's question. Does it give a K1 then?
It does not, no.
Yep. All right, cool. And yeah, he said thanks for the answers. So all right, so mine, you guys know, is going to be pretty unsurprising. It's not SCHD, by the way. Even though I've been buying SCHD, it's not SCHD. So let me hide your answer there, and I'll just go really quickly through. It's Life Storage. I mean, on the face of it, Life Storage is self-storage facilities. I have a lot of experience with it here in the Chicagoland area. I'm a subcontractor. We work for the corporate, so they have corporate owned facilities, and then they have third-party managers that they lease out, so they don't have to focus on everything. They can focus on like financing and acquiring more properties and doing what they do. And I didn't do it slickly. I was just gonna. Here, while I'm pulling that up, you want to answer Dave? By the way, Dave, we've both been on Dave's podcast here on the YouTubers.
So the K1 is probably a U.S. centric thing, but it's a tax paperwork that you get. So certain companies, the way they're structured for tax purposes, is a pass-through entity, and so instead of the corporation paying the taxes and then us as dividend investors pay the taxes, K1s, they basically funnel all that income through us, so we have to file taxes differently. And so the K1 is a form that is sent to all U.S. taxpayers if they own companies like this. And it's, to someone else's point, it's just an additional paper that you have to file when you do your taxes. Most tax software or accountants are very familiar with a K1, but it's just an added wrinkle or an additional thing you have to do when you file your taxes. But beyond that, there's no real issue with them.
Well said, man. Well said. So the one thing I want to jump right to that I think makes Life Storage, and I've talked to a couple people that work there about what makes this so interesting, is that they have this warehouse anywhere concept. And essentially, I'll screen down to the third page here. Well, you can hear some of them are Allergan, Gilead. They do it with a lot of pharmaceutical companies. But this shows right here, this slide. I think you guys, you can see that on the screen. You can check in from all over the globe, obviously through the cloud. But so the product, if you had a bunch of products and you wanted to store them somewhere, but you didn't want to ship it directly, or it wasn't time to ship directly yet, you can pick a Life Storage that's near kind of the area where you're going to be shipping things. Either the company personnel or couriers like UPS, FedEx, or whoever can have access to the storage space and make the delivery. It's monitored. It gets logged in with RFID tags. It's really slick. And then when it's time to ship, the fulfillment just goes right through. And then the courier can come to Life Storage and pick it up, or the company will ship it out. They'll get it ready. They'll pick it up. And then the delivery goes from there to do same day delivery kind of in that region. So this is something that I think has really impressed me and I think is really cool. And it's just something that might catch on with other places. But yeah, it's called their Warehouse Anywhere. And just really quickly, one thing I love about Life Storage and like the public storage space is that it's really not capital intensive. I was talking with some people on Twitter saying, I don't understand Tesla's valuation at these levels because, dude, it's super competitive, super capital intensive. And this is kind of the opposite. You build the self-storage space and there's really not that much upkeep. The spaces are just, the little metal enclosure, and then you got a plastic cheap roll-up door to or little metal roll-up door that keeps intruders out. So anyway, yeah, current 4.53% yield. Won't get too crazy into the numbers here, but yeah, dividend growth 4%, 20-year CAGR, nothing crazy, but 11% in January 23. That's because in coming out of the last great financial collapse, the last recession, they cut the dividend. So we do want to watch out. It is pegged as recession proof, but this is something we definitely keep in mind. But I'm confident in them. I think it's great. And one of the last things to show you here is I love buying when the dividend yield's above the 5-year average and the price to, we always say PE, but this is adjusted funds from operation. Think of it like PE, won't get into it, is below the 5-year average. And again, this tells us nothing about the future. These are all lagging numbers, but still, it can give a pattern. And then the last one here to focus on is the adjusted funds from payout ratio, kind of like the free cash. We don't look at that for REITs, 74%. So it is pretty low. And what else did I want to show you guys? Here, Life Storage. Over the last 10 years, we'll do total return. I thought I had this set up. I guess not. It's just slightly outperformed the S&P 500 over the last 10 years, 249% to the S&P's 226. Total return is all distributions, dividends, by just things like that. And then I'll end it with this. The intrinsic value currently, this is why I had been buying. It's the base case, $118.47. It's about 11% undervalued. And the worst case, come on, baby, you can do it. Come on, $102.01. So about 3% overvalued. And if we go back to this, I will show you guys a white screen that just looks awesome. And I guess I won't show you. I was telling Jeremy earlier, I was having issues with this, but my average cost anyway is, isn't this great? You got to love this, right? For Christ's sake. Yeah, there we go. Fantastic.
There's been a couple of new life storages popping up in my area here in Tampa, Florida. So it's nice to see it in live, out there in the community.
Yeah, you're right. And they just showed one when I was looking through this. There you go. They have lease up properties. They don't develop new properties, but so in Chicago, I'll tell you a few stories here, but yeah, there's 4 stores in Tampa, Florida. Right there. That's pretty neat. Here we go. This finally came up. I don't know what's the deal with my computer here, but this is not the key metrics. Here we go. My shares. So I just started this not too long ago. Currently up to $115 in annual income, and I'm already up almost 10%. And it's like when we buy these stocks, I have 24 shares. And it is currently at $96.91 is what that is at. But, when we buy these stocks, it's almost like we don't want the world to know about them because if people keep buying, it's going to push the price up. So, I mean, right, Warren Buffett always says one of the best things is when they take a position that they love it when it drops and when it goes down and people don't want to buy it. And it's almost like that they don't want to tell people what they're buying because then people are like, oh, Berkshire's buying this. We got to run in and buy it. Interesting thing with life storage that I have seen. So there's one on Grand and Pulaski here in Chicago, excuse me for my accent, but I think there's people that live in these sometimes because we were fixing a door and there was transients kind of looking sketchy, would come in, be in for a couple hours, come out, and then they go in for like an hour and come out. And then there was somebody in a car that had just all their stuff in it. So I think people are renting a space and kind of living in it. Like they're staying in the car, but if it's maybe like too cold, then they're going and sleeping in the storage unit, which they're not supposed to do. But interesting. So in a way, it's almost doubling as a hostel life storage is. And the last thing I saw there that was kind of interesting on that one, there was a Salvation Army right across the street, and people were just coming with like shopping carts full of stuff right after it opened and just going into the life storage and then coming out with the empty shopping cart. Like one of them, this woman had a cart full of shoes. So I think they're selling them unless she's a hoarder. I think they're just shopping and using it as like the storage, like the warehouse, so you got that on the lower end of the warehouse anywhere, but a lot of interesting things going on at life storages, especially in the inner cities. And they do buy really old buildings. There's a couple 100-plus-year-old buildings here in Chicago that were like factories back in the day. And they paint them, they gut the building, they put all the storage units in it, and then use the big warehouse lot, the yard. There's tractor trailers, there's RVs, all kinds of stuff that park there. So really interesting thing. I think they're a well-run company. They don't have a ton of debt, and I like their dividend pushing 5%. So that's mine. Jeremy had BAM and I had LSI as our 2 picks. And
I think it's a good choice there, Russ, for sure.
I think so. I hope so. Hopefully it's so.
Yeah, the self-storage is, generally a pretty good industry. And if you look at historically, their returns of the industry have been phenomenal because, to your point, it is an asset-light type of operation. Once they have the building set up, it doesn't really cost a lot to maintain. What do they have? 1 or 2 workers there and some, security and building maintenance. But beyond that, it doesn't cost a lot to keep things going. And once someone signs up for a storage unit, they usually keep it for many years
Yep.
because they either forget about it or don't want to have to deal with it, whatever. So there's a lot of recurring revenue there. So good choice.
I think so. And I was just looking, I'm putting a video out later in the week on AT&T, and that is the opposite. That is a very, very capital intensive business. And it's kind of turning me off about how capital intensive it is for them to build out their 5G and their fiber. And put it this way, just this last year, they spent over $60 billion on, I think it was like 23-ish. They took a non-cash impairment charge on their goodwill, meaning that interest rates are rising. So it's a dollar today is worth less because of the higher interest rates in the future. So they took a 23 billion hit on that. They've spent like, I think 26 billion on 5G and fiber build outs. And then they also spent, I think 25 billion on paying down debt. So that would be about 75 billion if I did my math right, or somewhere in that neighborhood. But it's a lot, and it's really, really capital intensive.
Yeah, it's unfortunate because obviously for that type of business, you have to spend that money in order to get future revenue. So if they cut back on those expenses now, they're going to be behind the ball when it comes to future revenue. So it's one of those necessary evils, if you will.
Yeah, and I'll let you talk in a second here. I wasn't going to show this, but I'm going to pull up a chart on AT&T and show. Actually, we'll do it. So here we go, real quick here. Answer a few before I do that. There you go, Bob, former Navy guy building his SCHD position. Me too. I bought 2 shares this week. I've been frustrated with the market because the thing is like Michael Myers, dude. It just will not stay down. It just will not.
Yeah, it's definitely been quite the bump this last month, and I think it took a lot of people by surprise. And I'm with you. I'd rather it stay lower for longer, but the market has a mind of its own. So it's, we're just little people in the big scheme of things. So you just have to ride with it. Yeah. So I absolutely love SCHD, Bob. I have 1,500 plus shares at this point, so it's definitely a huge position of mine. I think that's one that you can buy almost at any point going forward. Just average in when I have the money. So I don't think you can go wrong with that one.
Yeah, here. You know what? Screw it. I'll bring everyone with, and we'll do the, you can watch me build the chart here and show you how poorly AT&T has done. And unless this is going to give me problems. So yeah, and I'm Seeking Alpha, by the way. I have an affiliate link in the description below. So this is their charting, kind of cool. If we do a comparison, we'll leave SPY up there, or the S&P 500. We'll pop in, watch this Verizon and T-Mobile. How does my voice sound, by the way? Last week I had some issues with the sound, and hopefully it's corrected. So we'll do total return. Be prepared to be amazed, everybody. So 10-year, look at that. So out of 10-year, we got AT&T with a total return of 32%. Verizon 44%, S&P 169%. Granted, this isn't if you were reinvesting shares and getting more dividends, but just on the total return of those share price. And then T-Mobile, dude, 697.5%, clean their clock. So you can see the proof is in the pudding that AT&T and Verizon have just been pretty poor investments. And I guess it would be interesting to see the reinvested dripping, if you were to drip it, as they say. But, hey, hi, KC. What's up, KC? Oh, by the way, shout out to KC for Next Star Media. She brought that one to my attention, looked into it, liked what I saw. I understand the business, and they just did a 50% dividend increase, which just right away bumped up my patty by $18, your projected annual dividend income. And yes, strong storage demand correlates strongly with housing turnover. Yeah, like Jeremy was saying, man, people keep those spaces, and we should see. Let's see. All right, I'm gonna beat Ryan here. I'm gonna get caught up, and we're gonna answer what if you guys want me to look up something on Simply Safe or get our opinion. We'll check it out on Alpha Spread. Get the. Let's see. Help me. Here we go, everyone. Help Dave with his first U.S. pick. Down to O, Coke, or SCHD. Well, I think both Coca-Cola and Realty Income are a little bit overvalued, but I don't think you can go wrong with all three. But I know Coca-Cola is inside SCHD, right? So you'd get exposure to that. So there's a little overlap there.
Yeah, for me, I would definitely go SCHD, then
Yeah.
Realty Income, then Coke in that order if I had to choose.
Yeah, especially just SCHD has a nice. Here, I'll show you, Dave. SCHD has a very nice dividend yield. Isn't it three something?
Yeah, I think around 3.4 or so right now.
Look at you. Let's see. What am I typing? Let's see. 3.35%. And the dividend growth is 12% 10-year CAGR for an ETF. That's awesome. And 14% it was last raised. Currently paying $2.56 per share annually. And yeah, the expense ratio, I believe, is what, 0.06? Yeah, so for every $1,000 you have invested, you're paying 6 cents, if I'm doing my mathing right. Yeah, math wasn't strong for me. How about you? Are you good in math?
Yeah, no, I mean, it's really hard to beat out SCHD if you think about it. 3.35 yield growing at 13%, and the capital appreciation that you've seen in that over the years. I mean, that's how I compare all my other dividend investments to SCHD. If I can't beat SCHD, why bother? So that's kind of the way I approach it. So if I can't do anything good, SCHD is my go-to.
Yeah, that's what I did this week. And I'm still looking at some of the positions that I have overlap with SCHD. I'm going to eventually be, when the time's right, I guess. I don't know. I'll be selling those. And then I kind of did that with, I don't remember who I did that with, but this is interesting. Do you know what these are? What the TGI and HII scores are? Do you?
Sure.
I don't
Yeah, I would
know
love to
what
get
that is.
Chad on here. So I follow with Chad on some Facebook groups, and he has some really good resources out there. TGI, I believe, is total growth income, something along those lines. Sorry, Chad, for screwing that one up. But it's his ranking score. He ranks hundreds of different companies and keeps track of them. So from what I gather, TGI of 216 is a little bit in the middle. Chad, please correct me.
Yeah, let us know. Yeah, it's that's interesting. And I'm just going to plan on holding LSI for a long time, and I have it in the retirement account. So those dividends are completely tax free, and if it stays low, I will be reinvesting into those. Hey, Cody, what's up? Cody's here in Chicago with me. Citizen of the Year, it goes by, which it is COTY. It's his acronym, but UNP is looking attractive. Union Pacific Railroad. Do you own any railroad stocks, Jeremy?
I own a little bit of a CNI, which is Canadian National, but that's it, and it's a very small position. Kind of to your point on AT&T, the railroads is a very capital-intensive business. So, and the yields, generally speaking, are on the lower end. So, for my personal investment philosophy and needs, it's a little low for me. So, I tend to ignore those.
Yeah, I had sold 3M to take the tax loss harvest in my taxable account with 3M, and then I put it into Norfolk Southern and UNP, which were way down. It was in October I did that, and it was kind of fortuitous because they both ran up. I sold UNP, and I still have Norfolk Southern, which took a bit of a tank this week. Let's see. DL, I don't know what stock you're talking, or what stock are we talking? We've talked about a few, so give us a little. Unless that's for somebody else. Let's see. Here we go. Bob thinks the Fed's spoiling the party next week. Yes, I'm hoping for it. I mean, I know a lot of people are like, oh, fingers crossed they're going to pivot. I'm like, no, another 75. I need red. I need red.
I think the consensus is a 0.25% increase is what people are expecting. So if it's higher than that, then obviously that's going to spoil the party for sure. And then it's really all his commentary after the fact. So if Powell comes in real negative, just wait. It's gonna go down a lot, which will give us better opportunities. So I'm not too worried about it.
And in a way, the market is fighting the Fed, and they always say, don't fight the Fed. He wants to break the market. But then again, this could be the soft landing that they're trying to hit. So, which the soft landing is, oh, for Christ, I lost it. So we're looking at inflation abating, but jobs and economy staying strong, right? In a nutshell, that I think that's the soft landing
Yeah,
that
we'll
they're
see how
going
that goes.
for. Let's see. Oh, this is what Jim's buying. Next Era Energy and BKH, which I don't know off the top of my head. BKH, do you?
No, I'd have to look it up. Let me see.
Nice. Stumped us. I love it.
Let's see.
BKH. I don't know. I know I'm
Oh, Black Hills. Yeah, Black Hills. Utility company up in I think Montana, North Dakota area.
South Dakota. Yeah. And they're a dividend king, by the way.
Yeah, they are. Yep, caught us on that one, but yep, definitely.
Nice. And then KC Papa Powell. Papa Powell always has to push back against the bullish narrative. Yeah, I think it's gonna be this is why it's fun to watch. And you know what? In a way, for us that are dividend investors, it's kind of cool because the market goes down, stocks tank, we get to buy some pretty good companies at higher yields. But, if the market goes up, then we're getting capital appreciation on the shares. So I think it's, but I would rather get the higher yields and have it be down for a while because we know over the life of the market, it just goes up and to the right. And let's see, if the market will believe him or not. The market hasn't been believing him lately, Casey. They're calling his bluff, I think. All right, let's see. Thoughts on DGRO? That's not DeGiro, is it?
No, it's a ETF.
Yeah, I forget what DGRO is. MPW.
Yep. So, hey, Marcy. I've talked to Marcy a couple times. So DGRO, 5 years. So DGRO is a ETF from BlackRock through their iShares program. It's their dividend growth
That's
ETF.
right. That's right.
So it has really good names in it. It's I think like 400 different companies inside of DGRO. So obviously very stable. The only thing I don't really care too much about it is their dividend yield is a little on the low side, and the growth is a little bit less than SCHD does. So those two things knock it off for me. They also have a pretty high exposure to Apple and Microsoft, which are on the lower end of the yield. So my kids both have DGRO in their investments, but obviously they're talking 40, 50 years to go. But for me, the yield is just a little too low and the growth hasn't been spectacular. So I've chosen other things like SCHD and DIVO and things like that for my own needs. Have MPW. It's a really good yield right now, but it is a pretty shaky company right now. For those who don't know, they are a REIT for hospitals, mostly in the United States, but they also have some international ones. The problem that the market has with MPW lately is their largest tenant is gone through some financial difficulties. They haven't defaulted or anything, but there's some speculation that they might. So a lot of the market has pushed down MPW pretty hard. So I would definitely say it's a riskier play, but overall, I think you'll be okay. It's definitely a higher income. So if your timeline is short, it might be something to look into.
Yeah, and that's kind of why I sold OHI, Omega Healthcare Investors, is just same thing. They were having tenant troubles, and it just worried me enough. Plus, I mean, you always have that specter hanging over that they keep pushing more and more the government. There's more and more chatter about pushing back on Medicare and saying they're not going to pay as much. You know what I mean? So that's going to be less money for the operators. And obviously, like we've seen with IIPR, I mean, if you could be the best run property manager in the history of the world, but if your tenants aren't bringing in money to pay you, that's all that matters,
Definitely.
Oh, look, I got corrected. I love it. Total return does include compounding from dividends. I did not know that. So total return is if you're reinvesting the dividends. Interesting, man. Okay, cool. Then that makes AT&T look even more pathetic, in my opinion, over the long run. Exactly. I mean, that's just really bad because a lot of us, we poo-poo the SPY. They're one. Well, I know it was a little more back then, but like right now it's 1.4, like 1.5%, we'll call it, which is crazy because AT&T is like 5-ish, I think 6 now.
Yeah.
Weak sauce, man, from AT&T and Verizon. Which, by the way, I'm reassessing what I'm going to do with them. when I get back to even, because I think it's going to happen, as I was reading from AT&T, the feeling I get is like they said as they exit 2023. So 22 and 23, as Pascal Desroches, their CFO, said, these are their most capital intensive years where they're spending the most amount of money building out 5G and fiber. So they think they're going to see higher margins in 24, 25 and beyond as they just start reaping the rewards of all this spending. So I think they're going to have a little bit better earnings. And obviously we know that stock prices follow earnings over the long run. So I think I may have to wait until 2025, but I'm confident that, AT&T and Verizon are just both going to come back up where I can get out with a profit if I decide to. And yeah, we'll see then.
So AT&T, I just got back in the positive on one of my accounts, but the other one I'm still a little underwater. So I'm in the same boat. I'm trying to decide if it's worth keeping them as a very small percentage of my portfolio, or just drop them and find something more, that has better growth potential.
Right. And I mean, just look at, you saw it with T-Mobile. It's ridiculous that I would have turned a blind eye, and I still do turn a blind eye toward those. I'm like, well, they don't pay a dividend. And it's like, man, you would have made a lot of more money.
I definitely think better choices in the communication services sector and just in the market overall. So,
and I'm trying to take a key from
AT&T.
Yeah, from Warren, which is funny because, he says he stays away from capital intensive businesses, and then they buy Burlington Northern. So, never say never, I guess. Steve's still buying SCHD and Mo. Okay. What is that on his thing? That's a Star Trek thing, no? On that, what is that on your avatar there, Steve? I want to know. Acquiring minds need to know. Nice. Cigna. We had Cigna insurance. We did. I don't remember. We switched it. Oh yeah, we left Cigna. Now we're with Blue Cross Blue Shield at my employer. So that's interesting. Chad, any worries about, the healthcare space and eventually moving toward a single payer, or moving toward where, again, the government's just like, we're going to push back on Medicare payments. Here we go. This is one I don't know. I love it, man. Hazy. Do you know about Hazy?
Yeah. So a few months back, I did an article on my website about my top renewable energy companies, and Hazy actually hit number 6 on my list. So basically what Hazy is they invest in mortgages and properties related to renewable energy. And so they focus on buying the buildings and the infrastructure and things like that for renewable energy resources. And they're in a REIT structure. So I love the concept of what they do, but if you look at the returns that they've garnered, it hasn't really worked out very well. So that's why I didn't go higher on my list, but I do have a small position in Hazy.
I'm putting the link to your website right there. So again, definitely check out Jeremy's website. Oh, Steven just added TSN. Dude, that CFO, I think they should I would have canned his ass. I'm sorry, but
the one that bit someone's nose or ear or something like that.
No, that was, I think that was Beyond Meat. So the CFO, he's 32. He is Tyson's grandkid, and this fool got drunk and broke into his neighbor's house, and I think he fell asleep naked in her bed. And when she came home, he was passed out naked. So he got arrested for that, and of course they're slapping on the wrist. We're going to give him treatment, and they want to keep him there, but I don't know, man. That just looks really bad to me. Like you don't do. Come on, you're the CFO of a major company. I mean, let's see. Yeah. Take a look at ESS. Really looks solid after a significant discount. Yeah, that's one that I know has been had some chatter in the community, and I'll pull up the intrinsic value, and then we'll go to let me share the entire screen here. Let's see. We'll do ESS. That's Essex. No, is it? Mm-hmm. It is Essex.
Yep.
It's amazing how many tickers we get to remember. Of course, I need to type in the whole thing here. There we go. So they have an intrinsic valuation of about 7%. So again, that's pretty much fair value in my book. There's no exact intrinsic value number. Again, I always say it's like a range, knowing somebody needs to lose weight without knowing exactly how much they weigh. So it's just a ballpark figure because there's a lot of subjectivity that goes into it. But they're saying base case 206, worst case 176. And then I had Jeremy's site up here. Look at that. Nice site, Jeremy. I like it.
Yeah. So,
can you search for individual stocks on your?
Yeah. So on the site over on the top right hand corner, there's a search field. You can type in tickers, names, topics. So yeah, definitely.
Yeah, Cincinnati Financial raised their dividend. So ESS gets a dividend safety score of 93. And again, these are subjective to dividend safety scores. Yeah, and let's see their dividend growth. Not bad, 6%. So about average across the board. Oh, that's right. They are a dividend aristocrat. I put together a video that I recorded this morning where I went through every dividend aristocrat to find out the most undervalued dividend aristocrat. And it's in a spreadsheet you guys will be able to log into and check out. And they're right around X dividend. Nice, $8.80. Looks like they're getting ready to increase here as they've just had their fourth payment. So let me see their AFFO. Nice. Yeah, their dividend yields 31% above the 5-year average and only a 66% adjusted funds from operation payout ratio. So looking good, man. That's an interesting one. And that's one that I may have to consider going forward. Do you own ESS? I don't remember if you said.
I do not, no.
Yeah, I'd have to look into it, dig into it. And let's see. Kramer likes Bros. What's that? Dutch Brothers, right?
Dutch Brothers, yeah.
Dude, I made some money. I swung trade Dutch Brothers. What are they at now? I think I bought like 5 or 6 shares. I think I made $10-15 a share or something. Let's see. Bros. Here, let's get an you do that, and I'll bring up an intrinsic value for Bros. I'd be really curious to see what good old Alpha Spread has on Bros. Dutch Brothers. Have you ever had Dutch Brothers? Because I have not.
No, as far as I'm aware, there aren't any near me.
Yeah, and me neither. Here in Chicago. Here we go. $17 intrinsic value, and they're at 37 now. And the worst case 13. And let me see. One thing that's kind of cool about this Alpha Spread right here is the competitive landscape. Not a whole lot of overvalued, except for Compass Group. Interesting. Chipotle. It's burrito season. They're hiring new people, everyone. I just want to see if the insiders are buying, which they're not. So during the last 12 months, there's been more net sells than there have been buys. So that's Bros. I don't know. It's speculative.
Yeah.
I'd have to look.
Because they IPO'd recently, I think it's still just a hot trend. So, people are bidding it up. Whether it's worth it or not is a whole other thing.
Yeah. So these are proprietary to Chad then? Is that what you were saying? His TGI and HII?
Yeah.
Dude, I love that. I love it. I don't have anything like that. I need to figure out something like that.
Yeah, Chad's a great resource in the dividend community. So good stuff.
And he's on in your Facebook, or because I don't think I've seen him on Twitter, or is he on Twitter? I should get on Facebook. I don't know. I'm not. I'm still only on Twitter.
I do it for the groups, not for the personal stuff on Facebook.
Yeah, the Dividend Talk guys have their Facebook page, or group.
Yep. Sure.
Yeah. Here you go. He's thanking you for the financial advice, and he's putting all his money into SCHD now. So
that's a running joke, Dave. Is that every time we talk or every time he does the podcast, it's like it's not financial advice. Playing on that.
Nice, Chad. Thank you for weighing in on Hazy. The number. By the way, for anyone just joining in, we gave our picks. For Jeremy, it was BAM, Brookfield Asset Management, which is the parent. So all the little tiny, I don't know what to call them, the little subsidiaries, the little BAMs running around. Yeah, and then I picked Life Storage, ticker LSI. And yeah, so he just said Hazy's just okay. Slow dividend growth, short history. Yeah, nice, man. Nice. Matt Money in the house checking in. You Rich. Hey man, trying to be. We're all trying to get there. Look at this. Lucid. That's a well, they're autos, right? EVs. Yeah.
Lucid Motors, yeah.
Yeah, BKH. Now they're Bank of Hawaii. That's BOH, I think, right?
Yep.
Hey, Casey, you missed it. I said they were, Jeremy and I knew they were Dividend Kings, BKH, up there in the Black Hills of South Dakota.
Just didn't recognize this ticker at the beginning, but yeah, definitely know them.
Yeah. Hey, I think I only have space for like 379 tickers exactly in my head. That 380th escapes me, you know? Let's see. 5-year dividend growth CAGR. I don't remember. That must be for Hazy, 5.89. Yeah, I wouldn't invest in Lucid. Everyone who trade got out Friday. See, I'm not big on trading. I don't know. I tried it. Are you good at trading?
No, it always goes the opposite way for me. So that's why I stick with dividend investing. I do some options trading, but not stock trading.
There we were. Yeah, we'll touch on that in 1 second. But my problem, and when I found out I was a really bad trader, is I would never sell. I would pull my stops, and then I would just sit and wait for it to come back up. And then it would come back up, and then I'd be in the green. I'd be like, it's going to go higher. So my problem is I just buy and hold to a fault. So in the world of dividend investing, man, it works like a dream, unless you're buying AT&T. Yeah, she's front running Atcore. So this is one of her babies here is ATKR Atcore upcomers. Overweighting the position, so that's all she's buying. Nice. Yeah, that's one. I have a little stock thing on my screener. We got Casey's picks in there. Keep tabs on some of hers. General Dynamics with U.S. sending tanks to Ukraine. Any thoughts, Jeremy?
So I own GD. I've owned them for a very long time. Obviously, it's done really well for me. This General Dynamics, so they do tanks and other military stuff. To be honest, I don't know if sending 14 tanks to Ukraine is really going to move the needle for them. It might actually be more negative press than they want. So I don't think it's going to affect them one way or another. They get contributing all the time, so I don't think it's really that big of a deal personally.
Yeah, contributing to you World War III isn't good.
Yeah.
What are you buying, Matt? What are you buying, Matt? The Spy, the Amazon, the Google, the Palantir, and the Ricklib. I don't know RKL. Rocket Labs, right?
Okay.
I think it's Rocket Labs. I don't know what they do.
Yeah, I mean, it's hard to go wrong with it,
right?
Especially at this rate, at these prices. I mean, so undervalued there. So, yeah.
Yeah, and then to finish up with Matt, he's owning Pepsi, J&J, and BlackRock, or lets them reinvest. Yeah. I don't know. I don't own fractionals. I don't like fractionals. I don't know.
Yeah, BLK is my number one company, so I'm always going to be a fan of those. So I'm right there with you, Matt.
Yeah. All right, let's see. I want to hear what he says. Yeah, T is not a large component of SPY, not even the top 10 anymore. Yeah, man, it's just, I don't know. When I get positive, I'm going to think, see, we're too far back. I got to speed up here to get back to, so I apologize if I'm skipping your comments. I'd love to spend 10 minutes on everyone's comments, but for brevity's sake, but does the total return include the spinoff? I would think it would adjust for that. I don't know.
Adjust for it, yeah.
Yeah, let me see here. Here's speaking of the spinoff, traded down. I know KC thinks WB looks WBD, the Warner Brothers Discovery, looks interesting. Here we go. It's the space station from the original Star Trek. Cool. I thought it looked like it, but my eyes aren't so good anymore. I can't see that tiny little thing. Make sure you click on Dividend Stockpile, Jeremy's website there, and follow that. All right. I know somebody wanted to talk about the wheel strategy, and so the wheel is options. I don't know if you guys trade options. You know me, I've kind of taken a pause from it. I left a bad taste in my own mouth by getting stuff called away, and then trying to get cute and get in a lot cheaper with cash secured puts as the price kept running up and getting further and further away. Here real quick, Kevin. What's up, Kevin? What's going on, man? He added ESS. Yeah, that's one that I'm going to look at. I'm sorry, I don't read. Not sure what that. What is that? That looks like Russian to me. Maybe
Yeah, no idea. Chad, you have to fill us in on that one.
that's not Walt Disney language. I'm guessing. Let's see. All right, let me. I think I got caught up. All right, talking about options. KC goes short fairly often if you count that as trading, which I do. So Jeremy said somebody wanted to know in their Facebook group talking about the wheel. And go ahead, explain the wheel to everyone. Fill us in.
Okay. So it is, as Russ said, is options trading. So generally speaking, there's calls and there's puts that you can do. So what the wheel is generally speaking, you start off with selling a cash secured put. So you have the money in your account that you want to use towards the stock, but you're not buying the stock right now. You're buying the option of buying it at a future date at a certain price. So let's just say you're doing Coca-Cola and you're saying, I'm willing to do a put for $60 on Coke. And so you'll get paid a premium to have that offering to someone else to buy their shares at $60. So the wheel is you basically start with a put and then you keep on collecting that premium week over week or month over month until it gets assigned to you. And assignment just means that the price went under your strike price of $60. And then once you own the shares, then you turn the wheel around and you do a covered call where you're giving someone the right to buy your shares from you at a certain price in the future. And for that, you're paid a premium up front. And then if the price ever goes over whatever your strike price is, then your shares will be sold and you're back to cash. And then you do another cash secured put and do another covered call. And that's why it's the wheel. It's just rotating through the options over and over.
Yeah. So it's definitely something that takes a lot of experience. And if you just are completely lost after hearing that, don't worry about it because it took me a little while to get the hang of options. And I shared it on the website. So last year I did a lot of options trading and I think I brought in like a little over $2,000, but I did a video on it. So two bad ones for me were Starbucks and JP Morgan, where I bought low 100 shares and then I sold covered calls to bring income. And then the price just started going up and I couldn't get back into them. I should have just bought outright, but I wanted to get a little bit of premium, like $80. And anyway, point being, if I would have just sat tight, I would have been thousands of dollars further ahead by doing absolutely nothing. And instead I did a lot of work, a little bit of fees in there from Schwab, like 65 cents each time you sell an option contract. So I don't know, man. I'm taking a break from options for a minute here.
Yeah, so I do a lot of options trading too. I think somewhere in $12,000 in premium in 2022 or so. So pretty good for the size account I have. So I do it two different ways. I do way out of the money strike prices on my holdings I want to keep, like my Pepsis and things like that. I just want to gain a little bit of extra premium. And then I have others that I do near the money, and I basically just in it for the premium. So I saw Matt Money talking about Palantir. So, do Palantir right at the money, get a few percentage points for a week's trade. And then I don't care if it gets exercised or not. I'm in it for the premium.
So when you do Pepsi, I'm sorry to cut you off. When you do Pepsi, you don't want to get those shares called away, correct?
Correct. Yeah. So I'll do like a delta of 10 or 15 or something like that. I basically get a few dollars and then just move on.
So what's your time frame? Like, I mean, literally, are you getting, because some of those I looked at, do you do weekly or do you go further out than weekly?
Yeah. I tend to stay weekly or 10 days, somewhere in that range. I feel like I have a better sense on what the price movement is going to be in that short time period. And so I'll pick a way out of the money strike and just gain, $10 here, $15 there. That adds up over time. It's basically like doubling your dividend over time. So.
Yeah, that's something that I gotta think about because so my problem is I start chasing premium because I'm greedy and I get with that greed bug. And it's so easy because I'm like, I'm going to do way out of the money. And like you said, I'll see one for $10. And then you start looking and it's, going up and up. And I'm like, oh, I could do this one for $89, but higher chance that it gets called away. So
absolutely.
I don't know, man. That's I might look at that again this week and just look at, so do you have a percentage that you go out of the money for, like say PepsiCo, like 10% or something? Or
oh yeah, not really. I just look at what the premiums are for the week and I really base it on the delta. Because
do you look at So do you look at charting at all? Because I like looking at charting, and half the time it's right, half the time it's not.
Well, that's exactly it, and that's one reason I don't tend to look at the charts.
And
I'll look
the
at the
delta. So go ahead.
I'll do the quick 5-day, 30-day just to see where the stock is trending, but I'm not going to base my decision on it. But no, I usually just pick something way out of the money that makes sense, and then we'll go with that.
And like he said, when it's something as a delta of 10, meaning that it has a 10% chance of happening, of getting called away or getting the shares assigned if you're selling a put, right? So it's a low percentage chance.
Exactly. I've only had one trade go against me that the price just shot up over the week, and I ended up having to buy it back at a loss. But other than that, I've been able to manage pretty well.
I love it. So here, we'll finish with this. Here's short setup is of an overvalued share price. Peers reporting poorly. Dude, KC just really goes deep. Market outlook downgraded. One macro headwind. So KC, I think, do you do naked shorting? I mean, not getting fresh here, but that's when you don't have the money. You're just like essentially borrowing it, and your losses could be unlimited. So when the price goes up, then the shorts are getting killed, and the floor is always zero, right? But there's theoretically no limit to how high a stock could go. So that's that. And then when the shorts cover, it means they're buying back shares, and that's why you get something called a short squeeze and all that. But let's see. Yeah, interesting. I don't know. I would never do that shorting, but I'm just happy, man. Just right now, just buying my stuff. I might look at Pepsi. I did get really close a couple times, really, really close. Oh, here we didn't even talk about Intel. So she went. So we got 5 minutes left. What are your thoughts on Intel?
Yeah, not a fan. I've been preaching against investing in the company for a few years now. Just every time they have an earnings, it always seems to be more negative and more negative. And every time I listen to the CEO or anyone talking, it's always, pie in the sky, things are going to happen, but it never comes to fruition. So I've avoided it. I've never owned it myself. And obviously, I watch it because it's a long-term dividend company, but I've never invested in it.
Yeah. And actually, that might be a good one to try and do a wheel on, I don't know unless you could get caught though. That's the problem. So I should add, when you do options trading, there's always the potential that you're going to get stuck with the stock. Like if the bottom falls out, you could get stuck with that. But I don't know. We'll see. I bought into what Pat Gelsinger was saying. I liked it that he was the chief technical officer, and Bob Swan, the CEO before him, was the chief financial officer. So I felt like Pat was more hands-on from inception to implementation, and he was down there like in the trenches with the troops, where you think of like the CFO, he's just up in the C-suite with the books all the time. So I don't know. That could be completely off base, but dude, it's definitely dark days, I've said, over there at Intel right now. And the only saving grace, and I honestly, I wouldn't be surprised if they did cut the dividend to preserve more cash. But right now, I think their dividend is costing them about $6 billion. And I think they have 20 I was reading cash and cash equivalents is somewhere like 24, 26 billion. So they have enough to cover the dividend for a few years. But man, things got to turn around kind of quickly.
Talk about a capital-intensive business. I mean, Intel, just to keep up with things, has to spend billions of dollars on different fabrication sites and equipment and stuff like that to get their things up. And you have all these other companies like your ASMLs and all these other companies out there that are pushing ahead, and so they have to keep up on it.
Yeah, and imagine if they didn't have the government money coming in. So, yeah. Anyway, Steve, they downgraded it to borderline safe. So that was just a thing that they did on Intel. And tell you what, man, email me, Russ at dapperdividends.com, and I'll send you what they had to say about Intel. So we made it, man. We made it again. And plug yourself. What do you want to say to the world?
Yeah, so, very active over on Twitter at Div Stockpile. Also part of some Facebook groups for dividend investing. As you see on the screen, I do run my own blog. I try to post there 1 or 2 times a week. different ideas about dividend investing, valuation metrics, motivation to keep going. So I really focus on the dividend investing. On that site, I have a way to schedule a one-on-one appointment. So if you want to chat for 30 minutes, I can do that for free. Just go on the site and click the time that works for you, set up a Zoom call for you. So I think the biggest thing is, even though we talked about individual companies, my focus this year especially is on buying ETFs and closed-end funds. So I'm focused on like SCHD, VYMI, which is the Vanguard International Dividend Stock, BDJ. So I'm really focused on the funds this year as opposed to individual companies. But I always leave a little bit extra cash for those good deals like Brookfield.
Nice, man. And I'm definitely going to be looking into BAM. It looks it's very interesting. I like getting that exposure to mining and materials. I like it. So all right, man. Well, again, make sure you check Jeremy out. And of course, you guys know me. I'll see you again. I'll see you next week, man. I'm always here. I'm putting out videos. I'm putting out stuff all the time. And yeah, if you guys, I hope you come back next.